Welcome back to the anti-bubble report. We're going to continue with the next section, which where I'm going to be discussing the relative value across the volatility and insurance markets. And I take on from the previous, where I was basically looking at the portfolio positioning, how not only we look for asymmetry of try to find the balance and look for options that are cheap in terms of premium, that are asymmetric, that is convex, that give us different maturity profiles, that carry very nicely, and where we have high conviction. This is the goal, right? It's obviously extremely difficult to do, but anyway, we do it in a way that we're also trying to take advantage not only of volatility, but also of other things available, such as skew or correlation, which are very valuable. So needless to say, we will always favor vanilla if we can. The challenge is sometimes they're not as cheap, or the carry could be quite negative. We've seen that with things like the VIX. So we'll try to take advantage of the skew, whether it's in simple ways, such as doing call spreads or put spreads, or perhaps entering into more exotic payoffs that do things like barriers, European or American or whatever, which offer very interesting profiles. And also we like sort of icing in the cake and a meaningful part, because it could be extremely symmetric, and a massive way to cheapen structures is to use correlation. This effectively introduces two assets, not just one, and we're looking for two events to take place. Might be gold higher and the S&P lower, might be gold higher, the Chinese yuan lower. As we will see later, it offers phenomenal discounts and something that could be part of the portfolio. Starting with gold, we see that this is a volatility surface. For those who are not familiar, on the vertical axis, we have volatility, and then you have two sort of horizontal axes. One is on the right-hand side, you see the term structure, the expiry, the horizon of the option. On the left-hand side, you see the at the moneyness. So whether the implied volatility refers to an option that is at the money, at the current forward price, or something outside. And when you run cross sections, as we did here, you see on the left-hand side, you see basically a cross section of what the volatility looks like over time, and you see that the market in the gold market, we're looking at a contango market. So the implied volatility increases over time. And on the other cross section, on the volatility, we see the smile that effectively implies that the market is willing to pay or pricing more fatter tails than implied by the log normal distribution. And this is something that, again, can be, it shows the supply-demand balance of the market, but it gives us also opportunities to try to find the optimal insurance. What you see here is a very simple example. It's a call option on gold. In green, you see basically the intrinsic, which is how much you will pay at expiry. You see the blue line, vertical blue line would be the strike, and at that point in time was where the market was. And what you see is the yellow and red lines represent the value of that option at different points in time. Obviously, as the longer to maturity, the more the higher the time value, and this benefits also from increases in volatility, etc. So in that sense, this is you can see the asymmetry from just a vanilla call option that gives you a limited downside in the form of the premium that you pay, and then unlimited upside, both through directional moves, in this case through a call option to the market going up, but also in terms of volatility, which is we takes two ways, gamma and vega, gamma being more the convexity, and vega being the benefit from this uncertainty, the standard deviation. So with that, interestingly, the gold prices we saw earlier, the contango, the skew, we favor strategies that actually try to monetize this. And what we're looking to do is we're looking to reduce the premium by potentially giving up some of the upside. Obviously, a scenario where in this example, you're buying an 1800 call roughly, that where you will give back some of the gains at 2300. At 2300, we're already making a ton of money. It's a very good scenario, but the market gives a decent amount of probability to that happening. So the idea of doing this type of payoff is, first, it allows us to reduce the premium up front. It allows us to reduce the negative carry because you're long the call, but you're in a way short the tail at the top. And also, very importantly, as the market goes your way, you see that the market is kind of caught between two sides. It wants the market to go up because you're long the call, but it doesn't want to go too much because you will hit the barrier and then you will lose some money. So if the market's going up, but you haven't quite hit the barrier, what you see is that the red line actually, on the right-hand side, you see that the red line goes up to the yellow line, and then the green line showing you that you're positive theta, positive carry. Whereas in a low price environment, it's the opposite. The red line actually goes down to the yellow and the green. So when you do this type of trades, it's very interesting, in my opinion, because we get, we're directionally long. We want the market to go up. We're long volatility and gamma, but you're kind of shorting that tail, that premium of extreme events. And it's something that you could monetize at any time. So if at the point in yellow, we decided to sell the option, you could monetize that value. It's not as attractive as obviously the green line. The yellow line is not bad, but the yellow will converge to the green. So this kind of payoff is very interesting. You can do similar things in multiple other ways. And that was one example that we like to use in the books. Moving on to the S&P, you see a very, very different, completely different volatility surface. Once again, we have the volatility in the vertical axis, and then the skewness and the term structure and the cross section. So you see the cross section on the left, the term structure, you see that the market, similar to gold, is in contango. So implied volatility goes up for any given strike over time. It's a reasonably high contango. But what is markedly different in some ways is the skewness. You see at the top of the right how the puts are actually very big. The market is willing to pay a huge amount or assign some very fat tail to the possibility of very huge negative events, whereas it gives actually a negative call skew to the top side, which is very interesting. So the idea is you take your log normal distribution and you sort of shape it with this skewness to kind of match reality. And what the market is telling you is there's this big premium, this big worry, for the right reasons for a potential sell-off, big sell-off in the S&P. So how do you take advantage? You could do something similar to what we discussed before, and basically cheapen up the options by creating profiles like this one, where you might be willing to give back some of those gains at the expense and reduce the premium, whereas keeping a more attractive carry and a symmetric profile. Needless to say, you want to run profiles that give you blue sky with others that are perhaps, that give you this sort of profile. What you don't want is a situation where equities collapse and you lose everything. You look really smart, you make money, and then you give back everything. So that's not the idea. You want to cheapen the structure by reaching good levels of return and different and diverse profiles in terms of gamma, theta, etc. So you want to have a diversified portfolio. This is just one way in which you could take advantage of that. You could do simpler versions in some ways through call spread, through put spreads in this case, which is just buying the high strike put and selling the other. This is more aggressive. It gives you bigger discounts and completely different carry profiles. So these are all complementary, something we will analyze in a lot of detail. Now, obviously, volatility is king. Nothing more transparent or widely followed than the VIX, and I think the VIX plays a very critical role as we discussed in the first section today, the bubble, anti-bubble, and what happens is when volatility goes up, value at risk goes up, people are forced to delever and reduce risk, liquidity starts to dry up, correlations start to polarize, and before you know it, you enter into a vicious cycle of risk destruction. And as I always say, if you were to compare markets to fluid mechanics, we have these two regimes: the laminar regime, where things are linear, predictable; the turbulent regime, where things go crazy and turbulent and chaotic. And that's what happens when volatility explodes. The market becomes pretty much a deleveraging machine, and that leads to more liquidation, and it sort of feeds on itself. So this process is well known. We've seen one of my favorite charts is this relationship bubble anti-bubble between the S&P and the VIX, and we see the melt up we discussed earlier, how artificial low vol can actually lead to these really high equity valuations, but this process is again very, very closely linked. So the challenge for the VIX is the carry, and what I mean by this is if you look at the newspaper or your screen and you see a newspaper, I showed how of a dinosaur I am. You look at the screen and you look at the VIX, you see one number, right? But that number, that index is not necessarily an investable strategy. So if you want an investable strategy, you need to buy futures on the VIX and you need to roll this. And by doing so, you're creating effectively a total return. And it's pretty staggering to see that even if the index, since we launched ICNEO, this is the beginning of this chart, is July 2018, even if the VIX is up 20%, the actual investable strategy would have lost 84%. Shocking. So you didn't make 20%, you lost 85. And this is all because of the shape of the curve. And you see that there's been periods of extreme backwardation, when the market goes crazy and expects things to normalize. But more generally, people are willing to pay this premium, ourselves included, to say, okay, yeah, things are calm now, but what if things go crazy? Unfortunately, this is something that can't be ignored. The negative carries has been over 10% per annum. This is why so much money has been lost, and it makes it really challenging. So playing with the skew makes sense. We see here, the current, the implied volatility for the at the money futures in the VIX is around 21. Is the strike. You see the implied volatility IVM is around 105%, which is very high in absolute terms, and you see sort of the difference in how volatility moves across different. So you see similar to the S&P, because they're kind of mirror images of each other. You see the very, very high implied volatility. In this case, 30 strikes is 136%, whereas the low strikes like 15 is just 73. It's still high, but so to take advantage of this, in the past we've bought call spreads. This has been a difficult year buying these strategies. We haven't had a single opportunity where these call spreads, even if they offered 20 to 1, 15 to 1 payoffs, never materialized. And currently we're more exposed through S&P puts, where we have a huge amount of convexity. But the VIX is certainly the king of all, and one to watch, but a very, very difficult and expensive one to play. So we need to find ways to do that are timing is important, but also structurally things that will try to capture some of the risk premium. Another interesting way to find value is carry. This is a bit of an older snapshot, but it shows you, on a very steep interest rate curve, what happens when you look at forward rates, and so what the market is implying. So if you're willing to bet that interest rates will remain low, which is our view, you could actually use this as a cheapening tool. And one of the trades that we have on is an inflation trade 5 years out, is equities higher and rates lower. And so by implementing that in this way, as a dual digital, which is a correlation play. You're betting on these two things happening: equities being up and interest rates staying pretty much where they are or being a bit lower. You get a very attractive odds in the region of 10 to 1 or higher. Now, another area that we'll talk later in more detail fundamentally, but interesting is the yuan, the Chinese yuan. I think one of the big areas of debate in the market. Going back to this, we see the term structure once again in contango. This is a more similar and typical market behavior for currencies. You know, you have a bit of a smile, even if the put is in this case there's a bit of a bid over on the call side. So the low delta calls have a premium over the puts, as you can see there on the volatility smile. And it's interesting also because you could use, as we do, Taiwan as a proxy. They're very highly correlated. They have similar paths. They've massively outperformed gold, and we think that this is an area of opportunity, both the yuan and the Taiwan dollar. And in the case of the Taiwan dollar, it happens to be very interesting because it's actually tail risk with positive carry. There's a very exceptional. This is eased somewhat, but things are still very significant. So when you build this correlation plays, I'll give you a couple of examples. This is a dual digital. A digital option is heads or tails, black or white. It's yes or no, 0 or 100. When you do digital, you're sort of betting on two events. You're betting, I think gold will go up, and I think the S&P will go down. Here is not just about the individual distribution. You need to think about the joint distribution of how these things will move, and to understand that you need correlation, which is a highly unstable asset. So in that sense, you have we accumulated insurance, you know, gold versus Taiwan dollar versus Swiss franc as a proxy to euro, and others that are currently worth very little. You see in the table there how much we have at risk. In some cases, 0.0% of the portfolio. You would need a meaningful gold up and not so large move down in the Taiwan dollar. And you see on the right hand side the asymmetry that we have in the books right now. In some cases, you know, over 100 to 1. So clearly, the time to expiry as these things converge to zero, the asymmetry could be very high. But you see that there's stuff already, you know, a few months ago, even years, that is paying very high odds. The other way in which we like to play this is a bit more aggressive, is a worst off. And here, you know, it's sort of feather or Rafa, you know, pick your choice. You know, the two things that you like. I like gold. I like calls on gold. I like calls on the dollar versus China. And a worst off tells you you're going to get the worst of the two. So you need both things to happen. In the previous case, the condition was binary. Here is unlimited upside, but it's way cheaper. And you see the sort of extraordinary discount to the vanilla options that we're getting. I mean, we're talking about an option that gives you blue sky on gold and blue sky on S&P down or China devaluing. And in some cases, we're buying this for, you know, as you can see, 70, 80, 90% discount to the cheapest vanilla, which is really phenomenal. So correlation can be very attractive. A lot of art, a lot of science into this process. Some of these things are correlated. The market, it's been you know, punishing gold and the yuan, and basically yuan higher, S&P higher, gold lower, VIX lower. All these things have been kind of one way. It is true that they could also go the other way, but they might do it in different ways. So with that, I conclude this part. I hope you found it interesting, and please join us for the following sections if you want, where I'm going to be discussing post diversification and other considerations. Thank you.